Thank you. Once more, I'm Dr. Sama Paul Samje, Chief of Service of Management Account at the Department of Public Accounting. This afternoon, I'm going to discuss about the recording or the innovations in the recording of tangible and intangible assets of the state. We first of all have to lay the benchmark to understand what are tangible assets and what are fixed intangible assets. Intangible assets are those assets that they don't have physical body, like licenses, research and development, patent rights. Whereas tangible assets, they are those assets or goods that they have what? Physical body, like tables, like buildings, like roads, etc. So our discussion is uniquely based on the record of accounting operations of these categories of assets of the state within the year, in the course of the year. Given that, in general, tangible and intangible assets of the state are treated in 3 times. During the constitution of the first balance sheet of the state, in the course of the period, and at the end of the period during inventory operations. But we'll treat the second phase, which is the accounting procedure for treatment of intangible and tangible assets within the year. Having said this, now they are treated at 2 periods, either during their entry into the balance sheet of the state or during their disposal or when they exit the balance sheet. Historical cost, that is, the original cost is the historical cost. Now, concerning assets, there is a condition or 2 conditions for an item to be recorded as an asset. The first condition is that that asset should be under the control of the state. What does it mean? It means the state can be the owner, proprietor of an asset, but if the state does not master the condition of utilization of the asset, that asset cannot be included or recorded in its books. However, the state cannot be the proprietor of a good, but that good can be recorded into the assets and follow up in its account if and only if the state masters the condition of utilization. With the existing accounting procedure, that is cash-based accounting procedure, we record assets and we don't follow them up. That is, we don't apply neither depreciation nor amortization of the assets. With the new accounting procedure, we are going to record assets as in private enterprises. We record them and then we apply what? Depreciation in the course of the year. Now, there exist 3 procedures that the state can acquire assets. We are talking about their entry. The first is either the state purchases it, like the church buys, the church pays for construction, the state receives it as a gift, or the state uses its own means to produce those assets, like internal production. As concerns these 3 methods of acquisition, the technique of recording differs with respect to the methods. If it is when the state concerns what the state buys, we have the administrative procedure and the accounting procedure. The administrative procedure remains the same. We commit, we clear, that is the vote holder, and pass order for payment. But for the fact that at the moment of clearance, the debt of the state is registered automatically in the books of the accountant. During reception, the accountant clears the waiting account and proceeds to payment, obviously after the control of regularity of accounting documents. If it concerns those that are received in terms of like gifts, the accountant records uniquely the gifts by what? Debiting account 2 in counterpart of account 1 theory. This account 1 theory is being created to record goods that the state receives as gifts. Particularly what concerns the production, that is on production, that's when the state uses its means of production. It is recorded in two phases. Within the year, when the state decides to use its own means to realize a project, or let me take the case of a building, all the expenses committed in the framework of realization of the process within the year, they are committed, passed for payment. The accountant receives, control regularity, and pays. At the end of the year, the vote holder would produce a statement of all the expenditures committed. When the accountant receives this statement, the accountant is going to record the production on process by debiting an account 2, because in account 2, those that have read the accounting chart, we have assets in service and assets in process. But in this case, when he received the statement of expenditures of production in process, the accountant will debit a class 2 of production in process and a class 76 production revenue of production in process. This activity, that is, we record the charges we pay. At the end of the year, we record production of process, is done each year until the day that, or the year that the project will come to fruition. On the year that the project will come to fruition, the accountant will write off the set of production in process that they were debited. He will credit them in counterpart of the production or the assets in service. This is what concerns their entry. In exit, the same procedure as in private enterprises. If the state decides to exit, or an asset can leave the balance sheet, or a good can leave the balance sheet of an asset, either when the state decides to sell it, maybe it has been destroyed, or the state decides to give out the asset as a gift. If it's an aspect that the state gives out the asset, there are two conditions. The transfer can be definite or temporary. If it is temporary, there is no accounting recording. But if it is definite, that is, the state decides maybe it is a building and decides to give to a local authority, or if it's a vehicle, decides to give to a local authority. There are two procedures. We are first of all going to record the complementary depreciation, and then record the exit of the good from what? The patrimony of the state. And every good leaves the assets or leave the patrimony of the state at their net accounting value. This is what concerns depreciation, the transfer, definite transfer. I repeat again, in definite transfer, two operations. We record the complementary depreciation, and we record the exit of the good from the patrimony at their net accounting value. If it concerns aspect of disposal, sales, the state is going to record two operations. The operations relating to the sales, that is, the accountant will realize the sales by what? Recording the right of the state over the buyer, record the collection or the payment by the buyer, and then in the second time, record the exit of the asset from the patrimony by doing what? Recording the same way the complementary depreciation and the exit of the asset at its net accounting value. In case of destruction, loss, the same procedure. We record the complementary depreciation and the exit of the asset from the patrimony of the state. But in this case, the account changes. If it is a normal, if it is disposed as sales, we use account 654, which is net accounting value of disposed asset. But if it is a case of loss, we record it at account 659. Another operation can be the re-evaluations of assets of the state. The asset of a state is re-evaluated if there is a constant increase in prices, in general prices, if there is inflation. To re-evaluate the asset, the first condition that the index of re-evaluation, which is usually the rate of inflation, must be clearly defined by the finance law. The categories of assets must be identified and stated in the finance law, and the date of re-evaluation given by the finance law. On the day of re-evaluation, the accountant is going to debit the class 2 with respect to the assets concerned in counterpart of account 1015. Difference in re-evaluation. Thank you once more for your keen attention, and see you next time.